If the financial system works down, ETFs are not going to do you any good. Mining stocks are not going to do you any good, right? These kinds of things, if the whole world falls apart. So what do you want it for? We'll go through a couple different scenarios of what you want it for, how to own it, but you have to know first, what do you want to own it for? What's your purpose?
Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Today we're talking about, should you go for gold? And AAA, there's a whole bunch of talks about gold. It's hitting all new time highs. It's fun to be in. It's fun to watch. It's crazy who around the world is buying up gold. But what do you do about gold?
And that's a great question, especially when it comes to retirees and retirement. And, so many times, in my mind, there's two reasons why to buy gold is what I talk to people about. It comes down to, what's your reason? Now, some people say, well, I'm just concerned, because like the Bible says in the end time that, gold is going to be worth a lot and a bag of gold buy a loaf of bread kind of thing. And I'm wanting to protect myself. And then other people say, well, I want to keep up with inflation. And I'm not so concerned about having, physical gold like that, but be able to keep up with inflation. And so it all depends what you want it for, what to do with it. Now, many of our clients are already involved with us. Just one of our typical things that we put in people's portfolio as a diversification item to help them to be able to stay up with inflation and grow their monies overall so that they'll be able to have more monies in the future when prices go up and everything like that. But, like in so many things what we talk about, right, Daniel, it's like purpose versus performance. Right? What's the purpose? What are we trying to do here? Once we get that straightened out, now we can go forward and do the other things that need to be done. But let's focus on the foundational purpose.
Right. And when we get to that, we would say, do you want exposure to gold or do you want to own gold? Right. And there's a big difference. So one is you want to see price appreciation. You want to keep up with inflation. You want leverage on gold. You want that exposure. The other is you're buying it for insurance. You're buying it because you're worried the banks are going to shut down. You're buying it because you have so much money, you want to get it out of the dollar, right? You're buying it for those. And so people get these things mixed up all the time and they own it the wrong way for their goal. So first you have to say, what do I want it for? Am I trying to get exposure to gold? Am I trying to earn a lot of money because I think gold is going up? Or do I want to own it? Do I want to hold it forever, pass it from generation to generation? Because I hear these stories about these billionaires that own all this gold, and it's in a vault in Switzerland or it's in Singapore, and they own it. So when everything breaks down, their wealth is protected. And you have to say, well, if everything breaks down, how are you going to get to Singapore to get it? Well, I have a private plane. Okay. So the pilot of the private plane, if everything's falling apart, do you think the pilot is showing up? And do you think you can get off of the runway? And do you think the fuel for the plane is, if it's that bad, or people will store it in a bank vault? And that's a great idea. But if banks shut down, are you going to be able to get into the bank vault to get your gold, right? So owning the physical is very good for those people who want insurance. I want to hold on to this, and if the world falls apart, I have it. But it also has to be in a spot you can get it. There's this gold bug, very successful investor, very successful entrepreneur, worked for a couple of presidents. And when he talks about gold, he will talk about, you need to be able to ride your bicycle to get the gold, because it has to be close enough to ride your bicycle to get the gold, because if roads are shut down and lights are shut down and trains are shut down, right? What's the purpose? If you're not worried about all that stuff, then you can talk about some gold investments. You don't need the physical. But the physical is for if you want the insurance because the financial system broke down, and vice versa. If the financial system works down, ETFs are not going to do you any good. Mining stocks are not going to do you any good, right? These kinds of things, if the whole world falls apart. So what do you want it for? we'll go through a couple different scenarios of what you want it for, how to own it. But you have to know first, what do you want to own it for? What's your purpose?
Yes, exactly. Purpose before performance, right? Let's take care of the purpose of the thing. You're listening to Financial Strategies. It's Andrew and Daniel Agemy, because people don't know what people don't know. We're here to be able to help educate you, to be able to make smart decisions so that you too can retire and stay retired. Well, we are continuing in our educational outlook. And I hope you have a pen or pencil down so that you can write this phone number down, because we have a report we'd love to put in your hands called The Importance of Financial Defense. And, when you're with what Daniel was just talking about, people are looking at gold, the physical gold, as a defensive measure. And so that is very important. And defense is huge in sports and in life and business. Defense is important. And so we love to put this paper in your hand, be able to help you learn more about what we're talking about today. 800-725-7616. 800, call now, 800-725-7616 for your free copy of Call by Name Financial Defense. Okay? Report on financial defense, 800-725-7616. Well, you're listening to Financial Strategies. Today's topic is, should you go for the gold? What retirees need to know. And so we're coming at you today. And Daniel, this is a great topic because people are constantly asking, what about gold? Should I buy gold? What are you going to buy gold for me when I invest with you? And you're my manager of my money. Well, what's going to happen, right? You just talked about the defensive measure, right? Having some physical gold. And that's the problem, right? What are you going to do with that physical gold? Most people don't want to keep it in their house, right? You're going to dig a hole in the backyard, ride your bicycle to it, right? What are you going to do? If you have physical gold, it's got to be accessible. That means it can't be in your IRA, right? It has to be after-tax money that you have in gold, and it has to be in a way that you could, if you're actually going to use it for trade like that, it's got to be small. It can't be
recognizable.
Gold bars.
It has to be small,
right?
And it has to be recognizable because if you made your own 1 ounce, gold coins, nobody's going to take that, because it could just be, there's been countries that have caught other countries where they cover lead with gold, and so it weighs the right amount, but it's not real. There's all these funny things, and that's why if you're using the gold for that insurance, for I buy gold and I hold it, it needs to be recognizable, and it should be divisible, right? It needs to be in a small enough. If you've got a 10 kilo or 100 kilo, you got to do some huge thing you can't even carry around. Like, what are you going to do? Break off a piece and give it to somebody, right?
Yeah. Well, in my mind, a good way to explain this to people if they haven't gotten what we're talking about so far is like, silver is a good thing too. Like people talk about buying gold, buying silver, right? And so, buying silver coins, right? Yeah. Up until 1964, we produced silver coins in this country. So if you have some coins that are silver, a 10-cent, coin, is worth a certain amount of silver, right? And so if you could get gold in that same fashion, that's a good thing. And, there's a lot of people out there that are selling gold. And they'll say, oh, you need to buy these collectible gold coins. Yeah. These are going to be great. If you're buying gold for this purpose, you're spending too much money by buying collectibles. You just need gold. It can be junk gold. It could be the equivalent of old, right? Let's say it's silver, right? Instead of buying silver collectible coins, you're buying silver coins, old U.S. silver coins. And, so that either way, you're going to pay less for the old U.S. silver coins than you are for the collectible silver coins, but they're going to do the same thing. So why pay for more? So anyway, talking about, right, that's the physical side. But sometimes people aren't talking about that, right, Daniel? They're wanting to have, the go the other realm. Or, are we ready to move on to that other side of it?
Well, so you jumped onto silver, and I don't think you said the most important part. You want a notable coin. So if you get the American Silver Eagles, right? if you're looking for the insurance of it, when the banks stop working, credit cards stop working, whatever that is, you need that. Because if you have an ounce of gold and that happens, an ounce of gold is going to be worth who knows what, $15,000, $20,000. It's gonna go up so high. It's gonna be insane. The world's gonna be falling apart. You're gonna have bigger problems to worry about than gold. You made some money on gold at that point in time, right? But if you need a can of soup, if you're starving, how many of your gold coins are you going to give for that can of soup?
Right. Right.
And there's no way to break that coin up, right? So that's where silver comes in. If you're actually looking for trade, then you can have a lot more silver coins to trade than if you go for gold, right? And so these are things that we're not going to advise people on. These are not things that we help people with. This is a personal thing that you have to do if you want the insurance side of the coins or the insurance side of gold. And people probably should have some of that, a small portion. But like you said earlier, AAA, this is not in your IRA. There's all these gold companies that you hear on the radio advertising, or you hear this place or you hear that place on your podcast. They're advertising all over. Cash out your 401k and buy gold. Buy it in your 401k. Do this, do that. And that will not work the same as if you take money that you have in the bank account and you go and you buy silver or gold and you store that in a safe place. That's the best way to do it for insurance. And then there's gold exposure. There's ways you can get gold exposures, a bunch of different ways. And that's what the show is more about today, is not for the emergency fund or the insurance fund as much as it is for the exposure and the cycles of gold. Because that's really what we want to get into, I think, today, is the cycles of gold.
Right. Educating people on how gold works. And that's a good point, Daniel. This is whatever things we talk about on here are not always things that we help people with. We view ourselves primarily on the show as educators and just trying to educate people to know what they don't know. That's why Financial Strategies with Andrew Daniel Agemy, that's what we're all about. And so today we're talking about gold, not that you can buy gold through us or anything like that. No, that's not what we do. Don't try this at home, right? Yeah, but giving you education on how that all works and answering the question, should I buy gold or not, right? What do you think about gold? Well, today we're telling you what we think about gold. Now, we have a video book that we'd like to give you today to help educate you further. Again, if you've heard me say this before, it's a 3 tracks, got 3 different whiteboard tracks, animated tracks that explain more things about how you can retire and make sure you stay retired. And so we'd love to be able to put this book in your hand for free by calling us at 800-725-7616, 800-725-7616. Call now. First 5 first-time callers, 800-725-7616.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategies with Andrew and Daniel Agemy.
My first real exposure to gold and the thought of gold probably was somewhere around 1979, 1980. I had a friend. He's getting ready. He was engaged to be married, if I recall properly. He needed money. He took his high school class ring. He and I were about the same age, took his high school class ring and sold it for about $350, right? So, gold in around 1980, it was somewhere in the vicinity, I believe, of $350 an ounce. And, I bought my high school cash ring, which is much bigger than his, so probably would have fetched the same, if not a little bit more. But 1975 were about $80 or $90, or from 1975 to 1980 or so, 5 years. I mean, that went up substantially in value, over that point in time. And ever since then, I kind of use that as my foundation for thinking about what gold is. And today, it's close to 10 times that $350,000, right? So I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about, should you go for gold? And AAA gold is a funny thing because some people like Warren Buffett call it a pet rock. Some people say funny things about we dig gold out of the ground. We look at how beautiful it is, and then we put it back into the ground, right? And the thought is there, we dig it out of the ground, then we put it into vaults that are underground to store it for safety, right? But gold is a funny thing. If we look at it in the 1960s, it was under $50 an ounce. And then it goes through these cycles where it just shoots up like no one can believe. And so up into 1980s, it hit a peak, which was, I think, just above 700. And then it didn't do anything for a while until about the great financial crisis, when people were worried again about money. And it hit an all-time peak going up into 2011. And then it didn't do anything again for some time. And then in 2023, it surpassed and held the surpassed peak from 2011. And so there's these long portions where it goes down, it doesn't do anything, and then it spikes up. And when it spikes up, it continues to go and blow people's minds. And of course, it gets euphoric. And that's when some people start jumping in at the very end, and then it'll be 20 years again before it catches up to itself and surpasses the all-time high. So what this gets into is gold somehow knows how to sniff out monetary debasement, money debasement, the money printers, right? And it always knows how to do that. How it knows how, we don't know, but it has done this for all of time, or all of recorded time, since it's been money, right? 5,000 years that it has been able to do that, back from the Roman times, debasing money, all the way to today when we're debasing money. And so the point is, you either own it, as we talked about before, and you don't care what the price is because it's your insurance, or you need to follow the cycles and be involved with it in the up cycles, and best you can get out of it when it goes into those long cycles where it does nothing.
Right. I agree, Daniel. When I look back and I had studied it, before, probably, more than 15 years ago, I saw all those, they had peaks and valleys, but, over, right. Yeah. I'm looking at this chart, 1980, right. It hit a peak, and then it wasn't that peak again until, around the, financial crisis, and all that. What was that? 28 years, 29 years that it didn't do anything, right? And then, we saw it, we experienced it, where it went up during the financial crisis. We were buying it for our clients and that kind of thing. Then we saw it come down. We still owned it, right? But that's okay because it came back, right? And, but it's got those cycles to it. It's just like the stock market. People don't realize that the stock market has certain repeatable and predictable trends to it, right? Which this show is not about that, but it's kind of what you're saying with gold. It has these trends, and you have to know when to buy and when to sell. And that's what's so key to having a professional manager watching that stuff, who knows when to buy, when to sell, if, when it's coming to using it for inflation purposes. So this is very good stuff. And, I'd just like to point out the fact that you and I talked about before we got on the air, right? That everybody is enamored with the S&P 500. And it, if you'd put $100,000 in the S&P 500 in 1999, today that would be $764,000. Hey, that's not so bad. Right? Yeah. 664%. That's not so bad. But if you put $100,000 in gold in 1999 and left it, right? 1.1 million plus, over 1,000% increase. Wow. 25, 26 years, 1,000% increase.
Say that again, because I don't think I heard you right. Did you say that gold from 1999 did better than the S&P 500, even reinvesting dividends till today?
That's right. Even investing dividends. Yeah.
$100,000 in the S&P from 1999 till today turned into what?
$100,000 in S&P turned into $764,000. But $100,000 if you invested in gold at that same time would be 1.1 plus million.
And with the S&P, you had some bad times in gold over that time frame. But with the S&P, you had a 50% drawdown. You got back to even. You had a 60% drawdown.
Yeah.
Got back to even. Had some good times up. Had a 45% drawdown during COVID. Just recently had a 20% drawdown. Wow.
Yeah.
And it's still,
and Daniel, this is really interesting.
Ahead.
Yeah, well, let me, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, should you go for the gold? We're always being asked, do I buy gold? Do I not buy gold? What about gold? What do you guys think about gold? And so today's show is dedicated to gold, and we promised this, and here it is. And, we have a book that we'd like to give you to go along with today's show, because not everybody out there is going to go invest in gold or invest $100,000 in gold. And so you need to know what to do when we're always talking about purpose versus performance. Now, if you're looking for gold for the performance, well, where's your purpose money? And what's your purpose money doing? Well, we have a book that we'd like to give you that will be able to help you in this whole process of understanding what do you put where. Very old classic book, very easy to read, called The Richest Man in Babylon. This was put together 100 years ago from ancient scrolls that was found in Babylon. About at that time, thousands of years ago, this guy, the richest man in Babylon, was telling his friends how they too could become rich. And we'd love to be able to put this in your hand. We recommend this to all our listeners, for themselves, for their grandchildren, for the children, whatever. It's a great primer. It's an easy read book. 800-725-7616. For your free copy of The Richest Man in Babylon. For the first 5 first-time callers, free, no charge, 800-725-7616. Daniel, when we're talking about this difference on financial strategies with Andrew Daniel Agemy, because people don't know what people don't know, right? When we look at the S&P, everybody's enamored with the S&P 500. And they think it's the greatest thing since sliced bread a lot of times. They feel it's as safe as anything, but it's not, right? Like you said, there was a 50% drawdown from 2000 to 2002, a 60% drawdown from 2007 to 2009, and then up to 2013, then it's had a couple others in between there. But on average, the S&P since 1999 to currently has done about 8% a year. Doesn't sound too bad, but compared to other things that are doing 7% with less than half the risk, that doesn't sound too good either, right? But let's compare it to gold. Gold did somewhere in the vicinity of 9.5% over that period of time. And Daniel, you and I chuckle all the time, right? Because people say, oh, it's only 1.5%. Well, that 1.5% over that 26 years equates to $400,000 more money, right? Yeah. It equates to almost 400% more money than what you started with. Who would balk at that?
It's insane. People don't, what 1.5%.
People don't understand compounding, right? Yeah. So there's things to be looked at here, and I gotta say, probably there's a lot of, I gotta say, there's probably a lot of professional financial people that have no clue to what we're talking about, that we're educating them at this point, which, hey, I'm happy to do that, right? But I've come across too many professional people in my lifetime that don't know what they should know, right?
Yeah.
Anyway, let's get on to this. Let's get off that. Let's keep going with gold, right?
Yeah. So gold, the bullion, gold, the physical, is about protecting wealth, right? And that's that paper you're giving out talking about protecting. It's about protecting. Now what people do when they want to get leverage on gold, they look at other things. So if you wanted to lower the volatility in your investment portfolio, you could put gold in there for whatever percentage. And now if you're buying a gold ETF, right? If you're buying a gold ETF, you need to be careful which gold ETF you buy, because not all gold ETFs are created equal.
There's right.
Allocated and non-allocated gold. So allocated gold ETF means that they take gold as much as you can trust them, but there has to be some trust. They take gold. So you buy $100,000 worth, they take $100,000 worth of gold, they put it in a vault, and it has your name. That's your gold. You own it through the ETF, but it's there. Non-allocated just means one of these big companies, one of these huge financial companies that has tons of leverage that you wouldn't want to trust them with your money, but you do. You have money with them. They say, we owe XYZ, we owe this person, right? They don't know your name. It's XYZ. It's just a number. They don't care who you are.
Right.
We owe that XYZ, we owe them this much gold. And it's written in a way where if they can't pay you, then they can kind of choose what value they give you when that happens. So if you want the gold exposure in your portfolio, you need to be very careful which fund you buy so that you don't get contracts of gold where they have to pay you back at some point in time if they can. But there's actually allocated gold. That's the most important thing probably in this show, is understanding that, because a lot of people will buy gold ETFs thinking they have gold, but it's just
paper.
Paper, and there's not enough gold in the world to cover all the paper contracts.
Right.
Listen to that. There's not enough.
Say it again.
There's not enough gold in the world to cover all the paper contracts. So it's a game of musical chairs. Somebody is not going to get their gold. So you need to make sure that you have the allocated gold if you're going to put gold into a portfolio.
Exactly. And, I said to people earlier, we don't buy physical gold for people, but we do put gold in people's portfolios, and we use, if I followed you right, allocated gold. Right.
Of course.
So there's a huge difference to that. Just buying GLD ETF is not allocated. So beware, folks, before you buy gold or your advisors buy gold. Maybe you might have to advise them. But, a lot of people are asking the question, can I retire? When can I retire? Oh, I hope I can retire. That's the one I hate. I hope I can retire. Right. So you can know if you can retire. You can know when you can retire. You can know what kind of shape you're in. And there's two different things, right? One is knowing what you look like the way you're currently allocated your assets. And then there's also if you reallocated your assets properly, how you can be prepared for it. And it may be the difference between night and day. So we'd love to be able to do an analysis for you if you're so inclined. This analysis takes quite a bit of time to do. And if I had to charge for it, I'd have to charge you $3,000, but because you're a radio listener, we'll do it for free. It's called the RRR, Retirement Risk Report, Retirement Readiness Report. We'll do a stress test on your investments and give you talk about taxes and where taxes come in and what kind of income it will provide for you and what kind of paycheck you can expect in retirement with your current assets. So we'd love to be able to do that for you, but you have to ask for it. Call us at 800-725-7616. You don't know who you are, so you have to call in and tell us so we can help you with this analysis. We'll have a brief phone call and we'll get going from that standpoint according to your will. 800-725-7616. 800-725-7616. Call now. The biggest mistake retirees make is not switching from the growth model to the income model. A good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
2025 is our 35th year in business. And 35 years ago when I started, I was attracted to James 1:27. It says, take care of widows and orphans in distress and keep oneself undefiled by the word, because this is pure religion. Well, I love helping widows. And there was a widow recently that was referred to us. And when she came to us, she had, if my memory serves me properly, about $125,000 of her, I think $500,000 in gold invested in gold. It was not in physical gold. It was in her IRA. And the first thing we said was 25% of your assets in gold is way too much. I'm Andrew Agemy.
And I'm Daniel Agemy. And you're listening to Financial Strategies. And today we're talking about go for the gold. And AAA, when we're talking about these cycles, you want to be in the gold at the bottom of the cycle. You don't necessarily want to be in the gold assuming you're just holding gold as the insurance through the valleys, right? If you're using it as an investment, what we're talking about today, there's a few different ways to own it. One, you can own the physical. And I think we talked about that. You want coins. You don't really want bars unless you're a billionaire and you just need somewhere to store money, right? You want recognizable coins, and you're not trading them. You're not selling them. You just hold them. They're going to pass on from generation to generation. That's the thought process. It's your insurance. And then we go into owning a gold ETF, for example. And the reason people would do that is because they think gold is going to do better than stocks, or they want the lower volatility. So by putting 10% gold into your IRA in an ETF with allocated gold, it can lower the volatility of the whole portfolio. In a gold cycle like we're in right now, where from 2019, 2018 up until now, right, gold has more than doubled.
Right.
And so that's been the last 2 years, it's had about 25, 26% annualized returns. That is pretty good in just the last 2 years. And that's the new all-time high, right? So in those types of cycles, it does more than just lower your volatility. You can actually earn some stuff. You can actually earn some return. And then we go into the third way people like to get exposure to gold. And these are the ones you have to be the most careful with, because we talked about the gold cycle where it doesn't do anything for 20 years or 26 years, or it goes down. And going into the miners of gold miners have been some of the best destroyers of capital there are, right? And that's burning your money, folks. Destroyers of capital. You give them your money and they destroy it. They burn it, right? They have not performed well. But if you get them in the right time, so you have to even be more the right time, because in these bad cycles, they just blow up, they lose money, they're not good stewards of capital. And then as we go into the bull markets, they start buying companies that get over leveraged. You make money, and if you don't get out at the right time, then they go through the whole cycle where they blow up. They got too much leverage. The gold price goes down. They're losing money. They're over debted. They're going bankrupt. And that's the cycle. So you need to know where we are in the cycle, so you know what type of investment to be in. I would definitely not want to hold a junior gold miner through any cycle. The only way I would want to own a junior gold miner is when you're in an up cycle, and then you get out as close to the top as you can, right?
Yeah, right. Well, that's very key, Daniel. The whole point of investing is what? Very simple concept. Buy low, sell high. And if you think about it, that's what retailers do, right? Walmart buys stuff for cheap and sells it for more. Restaurants buy food for X, right? They work it up, make it nice, and sell it for more, right? And gas stations buy gas wholesale and sell it for retail, right? Buying low, selling high. That's the whole point of investing. And when you don't do it that way, you get caught up in the wrong things, right? And you brought that out with this, right? Gold miners are okay if you buy them right and sell them right. Right? Flipping houses are okay if you buy them right and sell them right, right? The whole rental real estate is okay if you're making the right profit on the thing, right?
Right.
So that is huge. And in the story that I started with, right, the rest of the story, that's right, like I think really cool, right? Because she had $125,000 in an IRA. She had to have RMDs, which it just was the wrong thing. The people that put her in there was just totally wrong. So what was so cool was we ended up selling part of it for cash. We actually had her take her RMD in coins so that she took those and put those in her house or wherever she put. I don't know where she put them, right? So, but we'll call her Sue, right? And then the tax that she had to pay, we paid the tax with her non-qualified money, right? So that she could get as much bang out for her buck with the gold, right? And so it was a real cool way how it went out, because she wanted the gold for the protection, the long-term protection of the physical protection. And buying an IRA wasn't going to do that. She didn't know that. She didn't know what she didn't know. That's why she came to us, right? Mm-hmm. That's why we have this show. So, and then we were able to fix it for her, and all, no harm, no foul in the end, right? But that's like the fun stuff to do. But you're listening to Financial Strategies with Andrew Daniel Agemy, because people don't know this stuff, folks. People don't know what they don't know. And we're here to help educate you to be able to make smart financial decisions, especially when it comes to retirement. That's why the show is called Financial Strategies. It's about strategies. It's not about which investments to buy. It's not about planning. It's about strategies. Strategies are dynamic. Planning and investments tend to be a little bit more on the static side, but strategies, methodologies are dynamic and change and are able to go with the flow and with the changing times. So we're glad to come to you today. Excuse me. Wow. So we have a white paper report that we'd love to put in your hand today. And this one is called, Have I Saved Enough to Retire? It's always a question, right? Why people interested in buying gold a lot of times? Oh, I can make money on gold. Well, the key is, how much do you need to retire? Have I saved enough to retire? That's always the question. Do you have enough to retire? And we put together this report that's going to be able to help you to understand how it all works. The equation of TR equals I plus G. Total return is made up of income plus growth, right? If you want your retirement to be stress-free, invest for the I more than the G, right? And so we love to put this in your hand. You'll get some more knowledge. 800-725-7616 for your free copy. Call now, 800-725-7616 for your free copy. Today, we're talking about, should you go for the gold? Retirees need to know. We're talking about gold today on Financial Strategies with Daniel and Andrew Agemy.
Yeah, AAA. So it's funny, these kind of 8-year cycles in gold, and the last low was basically 2016, and so we've had tremendous upside since 2016. And the question will be, will the next 8 years be like the past 8 years, or will the next 8 years be like from maybe 1980 to 1988, right? That was not a great time to be in gold. And so those cycles really matter. Now, when we look at the monetary system, when we look at the debt, the $2 trillion of debt that the U.S. government has each year, when we look at what they owe people in Social Security and all these government programs, right? Entitlements. There's entitlements all over the place. And we look around the world and we see what central banks are doing with their money. Central banks are buying up gold, and they have been since around 2016 like crazy. They're buying. And that makes you think that we'll have more upside on the gold cycle. And so what do people want to do to participate in that, right? We talked about those junior miners. We talked about miners. Those are extremely speculative, right?
Right.
Who was it? Some famous writer was talking about how a gold mine is basically a liar standing at the top of a hole in the ground trying to sell you something, right? So you have to be Mark Twain. I think Mark Twain is credited for that. And so you have to be careful. Some people have been made 10x, 20x, 100x, 1000x returns on some of these speculative things, but it's knowing what you're doing. And we talk about this all the time, AAA. It's risk versus return. You need to understand how much risk you're taking on, and you need to understand how much risk you want to take on for that return.
That's right.
And then you need to do it in the right cycle.
Is the risk worth the reward? Right.
Exactly.
Yeah.
Exactly.
Yeah. So this is important, when you're People are always asking us, what do you think about gold? Should I buy gold? Are you going to buy gold for me? Right? All these things. And we've been talking today about, do you buy gold to actually have physical gold? Do you want gold for the inflation, the insurance aspect on your portfolio? What do you want gold for? Purpose versus performance. And there's a lot to understand and to know. And we're giving it to you today as been promised. And there's still more to go. But you've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, should you go for the gold? What retirees need to know. This father and son team coming to you, be able to help you know what you don't know. Be able to educate you, be able to make smart, wise decisions so you can retire and stay retired. Well, as we do that, as we continue to educate you, we have a special thing we'd like to give to you today. To the next 5 first-time callers at 800-725-7616. I'll say that again, so get a pen and paper out. But we have a video book. This is a cool 3-track thing. It's not an 8-track tape player, but it's a 3-track video book that has different whiteboard animated videos that educate you on different aspects of how to retire and stay retired. We'd love to put this thing in your hand. You're going to love this when you see this thing. 800-725-7616. Call now for your free video book. 800-725-7616. On now.
This is Financial Strategy with Andrew and Daniel Agemy.
There's this very important financial equation that many people don't know, don't understand. TR, which stands for total return, TR equals I, that stands for income, plus growth. TR equals I plus G. Total income equals income plus growth. So there's 2 ways of getting a return on your money. One is the interest, the dividends, the income being reinvested into it, like they do with the S&P with maybe 1 to 3% reinvestment. And then the growth is the share price, going from $10 a share, $11 a share, $12 a share. Problem with that is it could turn into an error, a loss, going from 12 to 11 to 10 to 9 to 8. Right? But if you've got the income coming in, reinvesting all those times, it equals a higher total return. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about, should you go for the gold? And AAA, cycles are an important thing to understand. This equation you're talking about, TR equals I plus G, is also a very important thing for especially retirees to understand, because if you sell your principal, you have no more asset. You have no more principal. You have no more assets. You have no more retirement, right? But if you can live off of the income, you do. Now, what does TR equals I plus G have to do with gold?
Well, I am glad you asked, Daniel, and I know you know, right? And you're setting me up for the audience, right? But hey, when we're talking about gold, the whole thing about gold is it's a growth. It grows. And it goes from, it's not $10 a share, it's X amount per ounce. Right, that's how we value gold, right? And we determined probably somewhere in the late 70s is $350 an ounce. 1969, 1970, it was somewhere around $25 an ounce. Can you believe that? But today it's somewhere in the vicinity of what, Daniel? 3,000 an ounce, 3,500 an ounce right now.
3,300, yeah.
3,300 an ounce. So that's all about growth. There's no income from that gold. it doesn't pay interest. It doesn't pay dividends. It's a buy and hold strategy or a buy low, sell high strategy, one or the other, right? In the purpose of the physical gold, buying it for insurance for the long term, that's a buy and hold strategy, right? Like you might buy a classic car or something like that.
I wouldn't even say buy. You're an owner. You own it, right? It's yours. When you're talking about the physical, it's not even talking about you just buy, but you're never set. You're an owner. You own gold.
You're planning to buy it. I mean, sell it. Okay.
Yep.
All right. Yeah. And that, so, you pass on generations, like you said, right? 40 years from now, it's going to be worth more. So it doesn't kind of matter. You could buy for $3,500 an ounce now, but 40 years from now, it's going to be worth more, right?
Correct.
Don't plan for it for yourself. Right. But it's a legacy planning thing, right? But then the people that want it, to protect their assets within their portfolio, there's the two ways that you talked about, right? One is the allocated ones that are kind of backed up by gold, and the other is the paper that's not allocated, right? The unallocated stuff like GLD, ETF, that kind of thing, right? And so there's these three things, but all of them are growth oriented. None of them are spitting off dividends and interest, right?
And that's why Warren Buffett laughs at people who buy gold, right? Because it doesn't pay you. The physical in the 401k or the physical in the IRA, right? That's the ETF. That can lower volatility. But it's not paying you anything. Just like you said, it's just to lower volatility. People will use that or people will trade it, but it's not paying you.
Right. Right, exactly. And, the thing is the diversification. You need the I plus the G. So if you're having just growth, well, where's the I coming from? And that's where I said, if you want your retirement to be stress-free, invest for the I more than the G. I'm not saying don't invest for the G. I'm saying more than the G, right? Because the I is going to provide that income, right? Where we've talked about, different shows on the secret to retirement, and it's the income is the secret. And so the point that we're talking about gold and where it fits in people's portfolio, but it's not exclusively, nobody should be buying gold 100% or 50%. Or even 25%, generally speaking. It's way too much in one kind of thing. That's not good diversification. But that's where a total robust portfolio designed to give interest and dividends, right, of income, that if you don't need the whole thing, you can reinvest it and grow your money the old-fashioned way with compounding. So that's really the key to the whole thing, right? And so that's where, when I gave the illustration of TR equals I plus G, that's why I'm saying that. So people can understand where gold fits. When we're talking about there's two paces of growing your money. One is income, one is growth. And this fits as only the growth side. There are some things that fit only income side, right? And then there are some things that do both. And, so the key is a robust portfolio. Well, let me let you know, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. This father and son team coming at you today to help educate you. I'm in my 4th decade of helping people retire and stay retired, but I want you to know, here, the title today is, should you go for the gold? What retirees need to know. And if you're in or close to retirement, here's stuff you need to know about gold. And so we'd love to bring this to you. And today, we have a book that we love to put in your hand to help you know further. This is called The Richest Man in Babylon. It's a book that was put together 100 years ago from ancient scrolls from Babylon thousands of years ago. And this has some timely, classic wisdom that matches up much with what the Bible says in regard to what to do with money. And we love to put this in your hand for you, for your children, for your grandchildren, for your great-grandchildren to read, to give you some fundamental, foundational advice to learn, to get experience as cheaply as possible by learning from the experience of other people. And that's what The Richest Man in Babylon is all about, helping you learn from the experience of other people. So we'd love to put this in your book in your hand for free by calling us at 800-725-7616. 800-725-7616. Call now for your free copy of Richest Man in Babylon. First 5 first-time callers. 800-725-7616. Financial Strategies with Andrew Daniel Agemy. Should you go for the gold? What retirees need to know. Daniel, we're getting ready to wrap up, right? And so there's a host of other investments. When we're talking about the I section, of the TR equals I plus G. There's a host of other things that can be done. Well, in particular, when we're looking to, we can get involved with stuff like we did that show previously on surviving the chaos with income, with things that can help do similar to gold, but yet a little different, right?
Yeah. Yeah. So we've got three ways to own gold, right? Number one, you own it as insurance in your physical possession where you can ride your bicycle to get it. It's that close. Number two,
right,
you buy an ETF that holds gold for you. And the reasons to do that, make sure it's allocated, are to lower volatility or because you're trading it. Number three are the gold equities. And so the gold equities could be what we talked about, the junior miners, very, very speculative. These are trading vehicles only, right? And you need a competitive edge for those. You could do the bigger gold miners, like the Barricks of the world, right? And they pay a dividend. So you can own those and you can earn a dividend and you can get leverage on the gold price. Again, you need some competitive advantage because they do well in up cycles and they do not do well in the down cycles. They're good, even the big ones are good destroyers of people's capital, of people's retirements when you're not in a bull run. So you have to be careful with those. These are trading vehicles. You don't buy and hold. And then the third one, so you could get some dividends off of those bigger mining companies. But the third one would be our favorite, and that would be the royalty and streaming companies. And these things have treated their investors very well. And these are a little bit more income oriented. They have leverage on the gold price, but what they do is they go buy streams of income from mines, a one-time cost, and then they earn these streams of income. And they can pay that to you as the investor through a dividend, or they can reinvest that money and buy more streams of income, kind of like we're always talking about the chickens and the eggs. And these things from 2011, the good ones from 2011 to 2023, where gold basically, it did an up and a down, but it was basically the same price, $2,000 an ounce. These things did similar returns to the S&P, maybe even a little bit better. So now that we're in a gold up cycle, these things could really perform. And it's a way to hedge against the money debasement. We did a show just about that. And that
it's called
story
Surviving the Chaos. Highly recommend that. Surviving the Chaos. Go back and look at it wherever you get podcasts or look at on the previous shows. Go.
That story you told about Sue, right? She sold down her gold, but has done similar returns because the royalty and streamers have done better than the physical. And that's been able to benefit her whole portfolio. Yes, they're a little bit more volatile than if you buy the physical, but they do well through the whole market cycle. And when you mix them in a robust portfolio, it can balance out the portfolio really well. And so those are really the three ways to get exposure to either own gold or get exposure to gold.
Yeah. Cool. This is exciting stuff, Daniel. And I hope the listening audience is enjoying as much as I am from that standpoint. I love being able to do this show with you and be able to educate people. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been, should you go for the gold? What retirees need to know. And, one of the things that retirees need to know is when or if or how they can retire. How does it work? And we have, because you're a listener of this show, we have put together an analysis for you. It's called the RRR, Retirement Risk Report. And it starts with a simple phone call to see if it's going to benefit you and help you and explain to you what it's about. Love to be able to offer that to you. It takes quite a bit of time on my part to put that together for you, but willing to do that because you're a radio listener. You can call us at 800-725-7616. It's going to help you know, can I retire? If you can retire, when you can retire, how you can change things to retire better. 800-725-7616 for your free RRR. Ask for it by name. RRR, Retirement Readiness Report, Retirement Risk Report. Listen, it's been great being with you today. Appreciate you joining us. It's been fun. Hope you've enjoyed it as much as I have. I know Daniel has. And we're looking forward to catching up with you next week at the same time, same station. And until that time, keep this in mind. Remember to invest. If you want your retirement to be stress-free, invest more for the I rather than the G. Bye now.